Hi, I'm Joe Zeidel, investment strategist at Blackstone, and welcome to our Q1 webinar, The 10 Surprises of 2019. I'm joined, of course, by Byron Wien, Vice Chairman, Private Wealth Solutions, and Investment Strategist. Welcome, Byron.
Thank you.
Over the course of this webcast, Byron and I will take you through his annual list of surprises for 2019, which we worked on together, and share our views for global markets in the first quarter. We will also leave plenty of time for your questions. With that, thank you for joining us. Byron, let's get started. To start, do you want to review your surprises for 2018? And as a refresher, can you walk the audience through what defines a surprise each year?
So let's begin by saying, what is a surprise? A surprise is something where I believe it has the probability of greater than 50% of taking place. And the average investor would give it no better than a 1 out of 3 chance. Usually I get 5 or 6 of them right, but I don't do it for score. I do it to stretch my own thinking and stretch the thinking of you and our other clients.
Well, thanks, Byron. Do you want to go through a couple of the surprises from 2018? Maybe what went right for you in areas where markets didn't pan out the way you thought?
Well, I was feeling pretty good all through the year until the end of September. But let's go through them one by one. Number one, China finally decides to place itself in a position as a buffer with North Korea. It agrees to follow the sanctions, withhold food and fuel from North Korea, and that was instrumental in bringing North Korea to the conference table in June. And right now, nobody's talking about a war with North Korea. A year ago, everybody was. The second one is populism, tribalism, and anarchy are spreading around the world. All you have to do is look at Angela Merkel in Germany to see, or the Yellow Vest movement in France to see an example of populism. Actually, the Yellow Vest is probably more an example of anarchy, and tribalism definitely is destabilizing the Middle East. So those first two look pretty good. I said the dollar would finally come to life. If you recall, it was pretty weak at the beginning of the year, and it did come to life, and real growth did exceed 3% in a few quarters, and will end the year at about 2.9. But the euro didn't go all the way to 110 or the yen to 120, but the dollar did strengthen. I thought the U.S. economy would have a better year in 2018 than it had in 2017, and it really did. The 3% year was not expected at the beginning of the year. I thought it would have a 10% correction, and it had it in February. But what I didn't know is that it was going to have a second 10% correction in the fall, and that drove it to 2350. So we didn't get quite there. So the market never made it to 3,000, but on September 20th, it was at 29.35. I thought the price of West Texas would get to 80. It didn't get there, but it did get to 75, and that was a pretty big surprise to everybody. But as we all know, it ended the year around 50. Number 6, I thought inflation would be more of a concern, which it is, but it really didn't get too bad. I would say both inflation and interest rates stayed pretty much under control, and the consumer price index never got to 3%. I thought interest rates would rise, and as you pointed out, we got to 3.25 on the 10-year, but then it sank back to below 3% at the end of the year. I thought both NAFTA and the Iran agreement would endure. That didn't happen. NAFTA was modified, but the Iran agreement was abandoned, and I think that was a mistake. I think Trump thinks it's a mistake also not to have participated in the Trans-Pacific Partnership, but he puts America first and is moving away from all multilateral agreements. Then I thought the Republicans would lose both the House and the Senate. They profoundly lost the House, but they gained seats in the Senate. So I got that partly right. But the midterm election is definitely being viewed by Donald Trump as a referendum on his presidency, and he's campaigning for 2020 even now. And finally, Xi Jinping I thought would try to slow down his economy, and he has tried to do that, but the economy, because of a loss of natural momentum, has slowed down more than he thought it would. And right now, he's doing everything possible to make sure it grows over 6%. So those are the 10 surprises. I would say I got a little better than half of them right. And we'll see how we're going to do in 2019.
Well, thanks, Byron. And let's go through the surprises of 2019.
Well, the first one is the Federal Reserve doesn't raise rates at all in 2019. I said they would raise rates 4 times in 2018, and they did. But I think this year that Powell has established his independence by raising rates in December, even though Trump urged him not to. And I think he'll establish his understanding of reality in 2019 by not raising rates at all until he becomes convinced that the U.S. economy has enough positive momentum on its own. I think the 10-year Treasury yield won't go above 3.5%. And so if you assume the yield curve is the 2-year 10-year or the 3-month 10-year, I think we'll still have a positive yield curve.
And that is one that's out of consensus, because it does seem like the market thinks the yield curve will invert in the second half of 2019, and that we'll see our first recession at the end of 2019 or early 2020, right?
Right, and the market also thinks the Fed will have 1 or 2 rate hikes. So thinking the Fed will have no rate hike is definitely a surprise. Then number 2, I think the S&P will go up 15%. Now that sounds like a lot for a year, but if it goes up 15% from where it was at the opening on January 2nd, that'll only take it to 28.75. And the high for the year was 29.35. So a 15% gain won't even take it to the old high of 2018. And you could expect plenty of rallies and corrections along the way. Number 3, traditional drivers of GDP growth, capital spending, and housing only make modest gains. If the economy is going to be as good as we think, and we think it's going to be 2.5%, if it does that, it's going to be the consumer and government spending that's going to drive it there. Number 4, this is a real surprise. Gold drops to 1,000. It's about 12.15 now. My thinking is that gold has been in a consolidation period for about 4 years. Everybody thinks if it breaks out of its trading range, it's going higher. So we think it's going lower. And why not? If the market is doing well, if interest rates are around 3%, there's a real cost of owning gold. Not only does it not have any yield, but you have to pay for storage and insurance. So I think investors are going to realize that gold is an unattractive asset and the price will drop. Number 5, the profit outlook for emerging market brightens. Very few people are in this camp, but the valuations are very attractive. The consumer, the middle class consumer in the emerging markets is still buying. The middle class is expanding. I think China, the Shanghai, could be up 25%. And the Brazilian market, which has already begun a march, could be up as well. Going to number 6, I think March 29th, the date for resolving the Brexit agreement one way or the other is going to come and go. Parliament will fail to reach an agreement, and the stalemate will result in the decision to have a second referendum. And in this one, the younger voter will hold sway. It's the older voter who was nationalistic, had a strong feeling of UK pride, and didn't want to be a part of the union. I think the younger voter will vote to remain, and that will be a big surprise. Number 7, the dollar was strong last year, but I think it'll stabilize this year. The Fed will be shrinking its balance sheet. It has declined from $4.5 trillion to below $4 trillion, and I think that will cause foreign investors to be less enthusiastic about the dollar. I don't think the dollar will decline as many observers do, but I think it will stabilize at its year-end 2018 levels. Number 8, I think the Mueller investigation is going to have some important revelations. They will go very close to the president, including members of his family and his closest advisors. But I don't think they'll involve Trump himself because he's not on the record with having said things directly to or with the Russians. So it'll hurt his popularity rating further, but I don't think it'll be bringing him to the brink of impeachment. Congress most people think we're going to have gridlock. I think Congress is going to get more done than expected. I think that they'll definitely preserve the Affordable Care Act and even make progress on the deferred action for child arrivals and on general immigration policy. And then finally, in number 10, I think growth stocks will lead. A lot of people think value is going to lead, but I don't agree. I think the economy is going to be slower. It'll be 2.5, not 3, maybe even below that. And that'll be a burden for earnings for the value-oriented stocks. So I think growth will be the leader. Now, every year I always have a few also-rans. These are either not as relevant as the 10 I picked, or they may be relevant, but they weren't as important as the ones that were picked. So the first one is there's still no resolution to the North Korean situation. Kim Jong-un doesn't dismantle his nuclear facilities, and there's feeling among some of the foreign policy experts that we should take preemptive action against him. I don't think we're going to go to war with any of them, and I actually think Trump's tough talk, particularly with China, is going to make some progress. And I also think that his America First policies will lead to some agreements on national security. I think China will pull out all the stops to grow at 6.5%, and that'll have a negative effect on the renminbi. Number 13, I think China is in a position to assume world economic leadership. By 2025, they'll be the leader in digital technology, they'll be the leader in biotechnology, and they'll have made more important strides in agricultural technology. They'll do bilateral agreements as part of the Belt and Road policy. So if the United States maintains its insular position, China will become the world leader in free trade. And finally, number 14, we're going to see quantitative easing back in Europe. Europe is slowing down more than they want. They don't want it to go into a recession. And so you're going to see the European Union or the European Central Bank move to a more expansive position. They had suspended that and become more restrictive. I think they'll go back to a more expansive position, but we'll see whether any of these four also-rans work out. I would point out that the also-rans for 2018 did pretty well. So it's, even if you don't follow them, it's worth paying some serious attention to them.
Well, thanks, Byron. And let's get into our outlook for 2019. And first, this is the radical asset allocation slide. So you want to take us through your asset allocation and also highlight a couple changes that are new for this quarter?
Sure. We still have 5% in global multinationals. All of you own those stocks. Those are, stocks like Unilever and Novartis and some Exxon and some of the U.S. drug companies. Then we moved, because of the market decline, we moved our U.S. long only from 10 to 15%. So that's the first part, and that's mostly U.S. We reduced Europe in the last quarter, and it's now only 5%. Emerging markets stay at 10. We reduced Japan to 5%. We have continued to have 30% in alternatives, 10% in hedge funds, 10% in private equity, 10% in real estate. So we have a total of 30%, 35% in long only and 30% in alternatives. Nothing in gold, because we have a negative position on that, but 5% directly in natural resources, 15% in non-conventional high yield and other bonds. These are mortgages, leveraged loans, emerging market debt, and then finally 10% in cash. So that hopefully adds up to 100, 35% long only, 30% in alternatives, and then 5% natural resources, 15% in more riskier fixed income. That's another 20, and then finally 10% in cash. And I think the important thing is to point out this portfolio is essentially all equities, because even the fixed income component is equity-like.
Well, you want to get into the U.S. fundamental story. And take us through the crowd sentiment poll, Byron.
Okay, well, crowd sentiment is, if you look at it here, on December 24th, it was at 43.9, right in the area that represented the bottom in 2016, 2015, and well below the bottom in the February correction. So we definitely have a bearish attitude out there, which is the perfect platform for at least a market rally. Now, when you have a real bear market, you can get it into the low 30s. If you look there for 2008 and there you can see readings in the low 30s. But 43.9 is still conducive to a pretty strong rally, and we seem to be in one now. Joe, why don't you take over here and take us through some of these slides?
Sure, and this is a slide that we've shown before in previous quarterly webcasts. And what we're looking at here is the historic growth rate of the United States going back to the 1960s, which had averaged about 3.1%, versus the actual real GDP growth rate, which after 2008, you can see it dropped down to about 2%, and that's where we've grown for about a decade now, with the exception of last year where the economy grew closer to 3%, maybe 2.9% will be the final number. And the reason to highlight this chart is a couple things. Number one, we're making the argument that we shouldn't count on 3% growth forever. Growth will slow to probably 2.5% this year, and it will probably slow a little bit further in 2020. Now, over the last quarter, where we saw a 20% correction in the market, or a bear market in equities, one of the things that investors did is they confused slowing growth rates with slowing growth. And it's important to really make that difference, because what we're talking about here is a growth rate that's going to slow down, not an actual slowing the economy. We're just not going to grow quite as fast as we did in 2018, but the economy, just like earnings, will continue to grow. The point on this chart, the second point on this chart I would make, is that we still have a long way to go before the economy overheats. You can see there's about a $2.9 trillion gap between the actual growth rate of the economy and what we had averaged historically. Now, there's no economic law that says we've got to close that gap. There's no economic law that says we've got to grow above trend in any way or fashion. That's not the point. The point is that our companies have been geared toward 3% GDP growth for a long time, and with growth averaging more like 2% over the last decade, there's still a pretty big gap in the economy before we start having to worry about things overheating. And one of the key calls to our view on the economic cycle is that it's going to go longer than people expect, and the reason is because we're just nowhere near closing that gap. We're nowhere near overheating. And recessions for most major economies generally start with excess capacity, right? Where you're overheating, where companies start planning for growth that doesn't materialize, and then they've got to start laying off people. And as you can see, we still have a pretty big gap between our historic growth rate and current, which to me suggests that there's still room for the economy to go before we have to start worrying about bumping up against the end of the cycle. And the reason to think that growth is going to remain structurally lower is really illustrated in this chart. And what the second and third bars point out here is, really the key to long-term GDP growth, which is it's just a combination of productivity growth and labor force growth. And you can see going back to the 1950s, productivity growth averaged maybe somewhere around 2% or so. And the labor force growth averaged around 1% or so. And there you got your 3% GDP. Well, in the aftermath of 2008, both of those fell below average and were growing closer to about 1%. And that was where you got your 2% growth over time. Now, our view is that productivity is going to pick up, and we could run above trend for some period of time. But I think what this chart is arguing is that the U.S. economy structurally should be growing somewhere in the 2% range anyway. So I wouldn't expect a return to 3% for any type of sustained period. What this chart highlights is where CapEx is being spent. I think this is a very interesting chart because if you think about what will drive productivity, it's generally CapEx. It's expanding. It's plant, property, and equipment. But if you look at this cycle, what we've seen is the amount of CapEx that's going to structures and equipment, your traditional plants and things like that that are going to expand your capacity, has actually been going down. And instead, there's been an increased spend on intellectual property, i.e. technology. And this is really important because what this chart represents is companies solving for very tight labor markets. And we'll talk about the tightness in labor markets in a few slides, but what companies have had to deal with today is not necessarily needing more plant space, not necessarily needing more factories, but rather trying to squeeze more productivity out of existing workers. So the way they're doing that is through technology and intellectual property. I think that will increase productivity, and I think that's going to drive growth. But what it suggests is that we're not going to be looking for a lot of cranes dotting the skylines, but rather continuing technology spend. And that's going to be bullish for the technology sector for a long time to come. What this chart looks at is consumer spending. This is average hourly earnings. And one of the 10 surprises was that was our view that the consumer and government spending are going to have to be the workhorses in the last leg of this economic cycle. And you can see average hourly earnings recently moved up to 3.2% per annum. And we think that number is going to continue to go higher. Now, what's interesting is when you look at the health of the consumer and the potential for consumer spending, it's not just the average hourly earnings. One other thing to take into consideration is that the hours worked has been increasing. U.S. workers worked more hours in 2018 than they did in 2017 or 2016. So you take higher average hourly earnings times a longer work week, And what you're doing is putting a lot more money in the consumer's pocket, and that's bullish because the consumer is about 70% of the economy. And the last point to make about the consumer is this: the velocity on our money is positive, and it's been increasing. In other words, not only is the worker working more hours and earning more, but the data tells us that they're spending their money at a rate that's faster than what we'd seen in 2018 or 2017, because that velocity is increasing. I think the U.S. consumer and government spending are going to be the next drivers to this cycle. This chart illustrates that the consumer's in pretty good shape. The delinquencies across all statuses have been declining, and I think it's further evidence that the consumer is really going to be the key driver to this last leg of the cycle. Now, this is a chart that we've looked at a few times in the past as well, and what it illustrates is that U.S. Rates around the world continue to be a lot lower than they are in the U.S. And this effectively argues that we're going to see a ceiling in our 10-year Treasury rates. I think that ceiling is somewhere above our current rate, but what you can see is that over half of the $38 trillion in sovereign debt is yielding less than 2%. So in other words, if investors want yield, there's still very few places in the world to get it. And with the most recent rally in sovereign rates, it means that your German bonds or your Japanese government bonds are yielding even less than they were at the middle part of last year. So there's even fewer options out there outside of the United States. I'll just illustrate a couple trends to watch here. First is our view on inflation. And we put inflation as one of the 10 surprises in 2018. It was something that was talked about a lot, but it didn't necessarily materialize in the data the way that we expected. Well, this is a chart that's illustrating or comparing the 1960s to today. And what they have in common is this: if you look at the decade of the 1960s, unemployment started off at around 7% and was cut in half to about 3.5%. And over that time period, core CPI in the 60s stayed relatively flat. You can see that all throughout the mid-1960s. Well, around 1962 or so, President Kennedy thought, hey, unemployment's coming down, the economy's doing well, we don't have a lot of inflation, let's go ahead and cut taxes. So they cut taxes for the first time in 30 years, and prices remained pretty stable. And then by the mid-1960s, 1965, 1966, the government increased its deficit spending. They increased the federal government deficit by 55% over the next 4 years. And you can see prices started to rise. And that's when inflation started to really take off in the late 1960s and continued all throughout the next decade, really until the early 1980s. So the reason why I make this comparison is because if you look at our employment, we started off around the same place, and we've seen unemployment now being cut to below 4%, and you can see our prices remaining stable. And then think about what President Trump did in 2018. Not only was there a tax cut, but there was an increase in government deficit spending. So in other words, in the 1960s, you took a stable economic environment, you cut taxes, you increased fiscal stimulus, and the result was inflation. In 2018, you take a pretty stable economy, you cut taxes, you increase fiscal spending, and I think the thing we have to watch for here is inflation. There tends to be a very strong correlation between wages and CPI, and I think wage inflation is where the story is really going to start. This is a chart talking about gold, and as you heard Byron talk in the beginning, we do think that gold is going to drop to about 1,000 after this long period of consolidation. The reason is because we see an economy that continues to move along. We continue to grow, albeit at a slightly slower pace than 2018's 2.9% growth, but we think we'll be around 2.5%. And we think markets are going to behave better. We think we'll see 15% out of the S&P 500. And our view is if we do end up with a more stable dollar and a more stable environment where the S&P and emerging markets are rising, then we won't necessarily need the safe haven that is gold. So we think gold prices are going to fall from here. European and UK leading indicators peaked. European and UK growth continues to be pretty weak, and we think there's still bad news out there. As we talked about in the 10 surprises, we think that the European Central Bank might have to jumpstart its quantitative easing at some point in 2019, and the reason is because of this. Your leading indicators after Brexit really started to collapse. And in some respects, the effects could actually be a little bit worse for Europe. If you look at 2018's performance, European equities underperformed UK equities by about 400 basis points. This is a chart that shows the relative attractiveness of emerging markets. And what this looks at is the PE ratios of emerging markets minus developed markets. And you can see for really the last couple of years, emerging market PE ratios have been below that historic average, suggesting you do get better value in EM. EM was one of the biggest underperformers in 2018, but emerging market equities are positively correlated to U.S. equities. They're just higher beta. So with the view that the U.S. is going to do fairly well in 2019, you get, I think, positive performance out of EM, but with higher beta. You tie that with attractive valuations, and I think you've got a pretty good emerging market story, and we think the leader in there is going to be China with the Shanghai Index. One of our other views is that Treasury yields are going to rise from here. Now, we do think the 10-year will stay below 3.5%, but one of the reasons to think that we could see a lift in the 10-year Treasury is that we do have this mismatch between supply and demand. And that is, we know that the Treasury has to issue more debt in order to fund its deficits. You know, it was, say, $1 trillion in 2018. We think it'll be $1 trillion in 2019. But if you look at the key holders here, you've got to really ask the question, who is going to be the incremental buyer? Well, we know the Federal Reserve is not going to be buying more treasuries. They're shrinking their balance sheet at about $50 billion a month. Now, they might slow that shrinking, but they are not buying any additional treasuries. China and Japan are holding around $1 trillion worth of treasuries each, but our trade policies are not exactly designed to bring China and Japan closer to us in order for us to hug things out. So we don't think that they're going to be the incremental buyers. So if you look beyond that, you've got Brazil and Ireland at $300 billion or so each. Now, we don't think Brazil and Ireland are going to be capable of stepping up to be that incremental buyer to absorb all that additional treasury debt. So if it's not going to be your usual suspects here, the Fed, China, or Japan, who is it? The burden's going to fall on the individual investor, the private investor who is buying treasuries either directly through Treasury Direct or through asset allocation funds or through other managers. And the individual has been buying a lot more treasuries. Their purchases have been increasing at about a 35% CAGR. But if you assume that the Fed continues to shrink its balance sheet and that China and Japan are not buying any more, then by some analyst estimates, the individual investor will have to buy over 80% of new treasury paper in 2019 in order to maintain an equilibrium rate. Now, when you look at the bid to cover ratios among the 10-year treasury auctions in the second half of 2018, what you realize is that the buyers haven't been showing up. In other words, we've seen less and less interest in that long-dated paper, and to me that suggests that we will see our treasuries clear, but they're going to be clearing at higher rates. This is a very interesting chart given all the volatility. This is one we've gotten a lot of questions on, and that is the role of passive investing and, by extension, algorithms in the market. And Byron, do you want to address this slide?
Sure. What this shows is that an increasing portion of the market is passive. It's either algorithmic trading or trading in ETFs, and the active funds that follow the old-fashioned way of analyzing companies, trying to project earnings, looking at valuation, that seems to be declining in popularity. And we think that that accentuates the trends in both directions. So the reason you've had so many 500 and 600 point Dow industrial days is because of this phenomenon. And we think it's having the effect on the individual investor of scaring him or her out of the market. There's an increasing feeling that the market is being run by professionals and the individual investor doesn't have a chance. And we think that creates an opportunity for knowledgeable active investors who thoroughly examine the fundamentals.
And this chart looks at the midterm election. And I thought this was an interesting one because we had our highest turnout in 100 years, and that was 50.4%, or 49.2%. The highest was in 1914 at just over 50%. And, you know, that suggested that not only did individuals have something at stake here, but I also think there's a read-through for the presidential election. Now, Byron, do you want to take us through the earnings?
Yeah. Well, particularly this chart, which is a dividend discount model that I developed in the 1980s, seems like a long time ago. Probably people watching this webinar who weren't born then. But right now, a good number to use for S&P earnings is 170. And if you know what the 10-year Treasury is yielding and it's yielding, let's say, somewhere between 250 and 275. So that would put the market somewhere between 35.46 and 31.03. That certainly gives us tremendous potential. Even if rates went back up to 3%, you would still have a market at 27.58 or above above where we are right now. So from a valuation standpoint, if you assume stocks and bonds compete with each other, the point at which they're equally attractive is well above the current level. And even if the 10-year goes back to 3%, we still have upside potential before the market reaches fair value.
And if I could add one more point here, Byron, I think it's something that's been lost on a lot of investors. When the market peaked, when U.S. equities peaked in September 20th last year, the markets were aware of slowing earnings growth rates, slowing GDP growth rates. They were aware of China, trade war, Brexit, and all the other risks. And up until that point, on September 20th of last year, the market was up about 10% year to date. So investors looked at all those risks and completely shrugged them off and just said, no, none of them matter. None of them are going to come to fruition. And then if you go to, say, the beginning or the beginning of January when the market hit its lows, investors were looking at all the same issues and thinking that every single one of them was going to converge simultaneously in order to end the cycle. Hence the 20% drawdown that saw over $3.7 trillion of market cap erased, which, by the way, is bigger than the GDP of India, the fifth largest economy in the world. But the reason why I want to make the point on this chart is because what investors missed through that drawdown is that the 10-year Treasury yield basically went from 3.25% to 2.65%. So in other words, most everybody was using around $170 to $172 worth of earnings for 2019. But because the 10-year Treasury yield came down, your fair value on the market basically skyrocketed. So in other words, the lower 10-year Treasury yield is actually bullish for risk assets. And I think that's a point that's been lost in this drawdown.
And when you couple that with sentiment, it's really a powerful reason to buy the market, which is why the market's responding right now, I think. Okay, this one just shows that we do expect lower growth. We were growing at 20% in 2018. We're going to grow between 5 and 10% in 2019 and maybe get back to 10% next year. In any case, earnings aren't going to decline the way we see it. We're still in a situation where S&P 500 companies are going to show growing earnings. And this one shows that, we got sucked in by this one too, that the market always goes up in the 12-month period after the midterm election, but it doesn't necessarily go up in the 3 months after the election. So we've got some time to run before this is proven right or wrong. But you can see here that there isn't a single case where the market went down 12 months later. But we're not 12 months later. So this would argue that the market through the remainder of 2019 does well. For global growth here, you can see that we're still projecting 3.7% world growth. So the world hasn't stopped growing, even though China is slowing down, Europe is slowing down, and the US is slowing down. But we're still in a positive growth environment. So you go ahead.
Yeah,
here,
just
Joe.
a couple slides here on Recession Outlook. And, we wanted to create a section here on our Recession Outlook because, so many people are asking the question, when is the cycle going to roll over? And if you look at equity market performance, equities are predicting that we are going to end up in a recession almost imminently. In 2018, the S&P 500 closed the year in negative territory. And if you go back over the last 60 years, there's only been 13 instances where the market was down on a full year on a total return basis. And 8 of those 13 instances occurred either immediately before a recession or while the US was in a recession. So in other words, if you look at the equity market behavior from the end of September until the beginning of January, the markets are basically telling you that they're pricing in a 60% chance of a recession. Well, it's our view that equities are not a good predictor of economic cycles. Equity investors, when they're investing in companies, they're investing in profits, they're investing in discounted cash flows. And as a result, equity investors tend to be more geared toward a business cycle or a corporate profit cycle than an economic cycle. If you look at credit investors tend to be better on an economy because when you're investing in credit, you're really concerned about a return of principal, i.e. a negative credit event that could happen in something like a recession. So when this market pullback started in September, it was really equities that led credit lower, and it was equity markets that really started pricing in much higher odds of recession. And as you know from listening to our views, we don't think that's the case. So these next few slides are going to argue, I think make a better argument as to when the cycle might end. This chart here just illustrates the point that the market goes up through Fed rate hikes. We think the Fed is going to pause in 2019, but they're not done with their hike cycle. We think that ultimately they will have to continue hiking. It's just that they're going to pause probably for the for 2019. And this chart shows that all throughout a Fed hike cycle, equities do well. It's generally only when the Fed cycle ends that you have to worry about equity underperformance. This is a chart of leading economic indicators. It's one of the preferred metrics that we use or indicators we use, but it doesn't have the best track record. But what you can see here is that leading economic indicators recently rolled over. If in fact we did see the peak on LEIs, the data tells us we have about 22 months before our next recession, which would push us somewhere close to 2021. But the point here is I don't think it's imminent. This slide contains our 2 favorite measures of understanding an economic cycle. It's the yield curve and average hourly earnings. And I'll talk about average hourly earnings first. Average hourly earnings are currently increasing about 3.2% in the United States. That was the most recent print from the month of December, and we think that they're going to continue higher. But if you notice, after the mid-1980s, the Fed really hasn't tolerated average hourly earnings above 4%. Once Volcker, the Fed chair who conquered inflation in the late 70s, early 80s, once the Volcker era ended, the Fed has been pretty vigilant about hiking aggressively when average hourly earnings hit about 4%. So 4% is the number to look at. We think we'll end up heading there because of the tightness in the labor markets, but we don't think we get there anytime soon. The second line on this chart to pay attention to is the yield curve. It is the best predictor of business and economic cycles. We could take this chart back to the late 1960s, and what you would see is that there have been 7 yield curve inversions, and they're followed by 7 recessions. It's an average of about 17 months from the time the yield curve inverts until you have a recession. And our view is that the yield curve will not invert in 2019, that I think actually it will start to re-steepen as the 10-year Treasury yield goes higher. So the point here is that the best indicators that we have, yield curve, average hourly earnings, and LEIs, are telling us that there's no recession anytime soon. We would take these indicators over equity market performance in order to help form our views on when the cycle is going to end. This is an important chart. This is looking at small business confidence, sales expectations, and you can see small business confidence correlates pretty highly with GDP growth. It's because small businesses really are the U.S. economy. And I think this is an important chart, especially in the face of the trade war that we're currently engaged in with China. And the risk is that if the trade war continues, if we don't find a resolution or some type of agreement with China, that it's going to start to impact small business confidence. If small business confidence really starts to roll over, then you can forget about the GDP growth because of that correlation. What small businesses do is what the U.S. economy is going to do. Our view is that confidence will remain at these levels. Confidence should remain high, and GDP growth should continue to maybe not grow as fast as we were, but still stay in a positive growth mode. But again, if the trade war is to spiral out of control, I think this will be the most important chart for 2019 because this will help us to understand what the small businesses are thinking and in turn what to expect with respect to GDP. A couple of the areas that we're going to be counting on for 2019 are going to be the consumer. One area of weakness here is capital spending and CEO confidence. And I mentioned before CEO confidence with respect to GDP. Well, here you can see CEO confidence and CapEx. And if confidence does fully roll over, then I think you can take CapEx off the table. And you can see in the bottom chart that CapEx growth, or the average age of equipment in the United States, is the longest it's been going back, is the oldest it's been going back to the 1960s. So there's a case that argues that our equipment needs to be upgraded simply because of its age, but we won't get that unless CEOs do find that confidence. This is looking at crude markets, and one of the questions we've gotten is our views on oil, and we did not put oil in there as one of our surprises for 2019. We had oil in there before, as Byron reviewed, from 2018, but we didn't have the conviction that oil prices would necessarily be going up, because we do think that record supply is going to dampen oil prices. But with global GDP growth staying above average, there's not a strong argument to be made that oil is going to fall much further from here. So we think there's a pretty good floor on oil prices, and the ceiling itself is going to be relatively constrained by high supply. So we think oil will stay at these levels, maybe move slightly higher, but we're not the biggest bulls on oil. Now, the flip side of that is gas prices are going to stay relatively low, so that benefits the U.S. consumer. Gas prices in the United States have fallen over 50 cents a gallon from their peak earlier in 2018, and that's bullish for consumer spending. Now, a couple pain points for the next recession, and this one's looking at the relationship between the tax cuts, fiscal government spending or stimulus spending, and global tariffs. And what this looks at is incremental spending, right? One of the arguments throughout 2018 was that the trade war didn't matter because the cumulative effect of tax cuts and fiscal spending were going to overwhelm any of the damage being done from trade. And an important key to that argument is that a lot of the tax cuts and spending, a lot of that benefit was seen in 2018, but the incremental lift in 2019 is not quite as high. Now, if you compare that to the potential tariffs that could be coming online, what you can see is there's more damage to be done from a trade war than benefit from incremental spending and tax and fiscal stimulus. This chart looks at the federal government deficit, and every 1% increase in the federal funds rate adds about $200 billion to the deficit. And that's something that could start crowding out spending over the long term. And that's going to have an effect not only on federal government outlays, but of course on corporate debt as well, because corporations have basically doubled the amount of corporate debt outstanding to over $6 trillion. So there's a fair amount of sensitivity, both federal government and corporations, that they're going to have to the potential of higher rates, and we think we will see higher rates. And this chart looks at government spending. About half of it is coming from individual income taxes. With taxes being cut, it means that we're going to run bigger deficits. This chart here, I think, is probably one of the bigger risks, although I don't think it's a risk for 2019. We're pretty bullish on credit, and we think that credit is actually going to have a pretty decent year this year. Credit is positively correlated to equities, and we think equities are going to outperform. So the credit spreads that have widened out since September, we think that they're going to start to come in again, and that there's going to be a pretty good credit story for 2019. Also, alternative forms of credit like leveraged loans, etc. But one of the questions that we get is about the concept of fallen angels. And over half of the investment grade universe today is BBB rated. In other words, it's the lowest rating of investment grade. And that's something that could come into play once the cycle rolls over. We don't think it will roll over anytime soon. We think the cycle will go on for longer. So this is not a risk for 2019, but I think 2020, 2021 or later, we could start to see that risk. And one of them is that if you do get downgrades from the BBB space to below investment grade, you can end up swamping the high grade or below investment grade marketplace because there is so much BBB rated debt out there. So with that, Byron, we've hit the all-important section of the webinar, which is our disclaimers, which is Blackstone's way of saying that if we said anything that's wrong, don't worry, don't listen to us, and we've got a lot of pages of those. But we do have questions that came in before the webinar, and so maybe, Byron, we could hit on a few of these questions and maybe cover maybe a few areas that we didn't get to. And the first question that came to us via email was this. Starting off with your first surprise, you predict no further rate increases by the Fed. One reader asks, if there's no recession and the S&P gains 15% like we think, Is there a risk that Powell will appear to be responding to political pressure by not raising rates?
Well, I don't think so. I think Donald Trump would like rates to go to zero because he'll do anything to get the economy. He wants the economy to grow at 4 to 8%. So I don't think he'll get political pressure from Trump. He might get political pressure from somebody else, or from Congress or so forth. But basically, I think no rate increases is probably going to be a benign stance. I don't, unless the economy heats up as you suggest, I don't think there's going to be political pressure to raise rates.
Great. Another viewer emailed and asked if we could discuss the drop in oil prices and also if we could make comments on gold and silver. I know we covered gold through one of the 10 surprises, but maybe you could take us through the oil price drop that we saw in the fourth quarter of 2018.
Well, I think the Saudis wanted to get Jamal Khashoggi off the front pages, and they did that by lowering the price. I also think that they wanted they saw the world slowing down, and they thought by lowering the price they would reflect that and maybe stimulate more demand. So I think the price of oil dropped because Russia and the Saudis wanted to and increased production as a result. And the Khashoggi situation gave Saudi Arabia a second reason.
Mm-hmm. And generally speaking, if you look at the data and the relationship between oil and GDP growth, it's important to remember that oil, like other commodities, are immediately consumable, right? They're pretty hard to store. And so as a result, they tend to reflect current demand. And what history tells you is when global GDP growth is above average, about 75% of the time, oil prices are higher. When global GDP growth is below average, that's typically when you do see the structurally lower oil prices. So we probably will see some volatility. I think there's a pretty good floor in oil prices, though, and that is global GDP growth remains above average. So while we may not necessarily see a return to 80 or 75 or whatever it was with oil prices at the end of at their peak last year, I don't necessarily think we're going to be seeing oil dropping in any meaningful way from here.
So we won't see $30 oil, but we may not see $80 oil either.
Right. One of the other questions came in, is it safe to say that fears of a China soft landing are largely behind us?
The hard landing is really the question. Whether or not China is going to have a hard landing. I think China is in a position to do something to prevent a hard landing. In terms of a soft landing, I don't know what you would call the current situation. The GDP is slowing down in China, but I wouldn't define it as a soft landing because it seems to be slowing down more than they want it to. But they have a lot of tools. They have infrastructure spending, so they have the fiscal tool, the monetary tool, and they also, they very desperately want to have a deal with the United States because the United States does $500 billion worth of business with them. So my view is that both China and the United States want a deal on trade, and so there will be one. And remember, China has one advantage over us, and that is this. If they decide they're going to do something on Friday, they can put it to work on Monday. They don't have to have hearings in Congress. They don't have to have a vote. If Xi Jinping decides he's going to engage in a vigorous infrastructure program, he can go ahead and do it. But there is the problem of Chinese debt. It's already high, and there's a limit to how much higher they're willing to let it go.
Mm-hmm. Yeah, and I do think that they will unleash any amount of stimulus that they need in order to arrest the declines of their GDP growth and it's also worth pointing out, one of our also-rans is that China could go around to the rest of the world and say, we're open for business, we want your trade. And they've already started doing that. They did that with European autos. in the fourth quarter of 2018, where they struck a bilateral trade agreement, gave a 75% ownership stake to a European auto manufacturer. They brought Abe in from Japan in order to discuss bilateral trade agreements. So one of the answers to this trade war could very well be that China goes around to the rest of the world striking bilateral trade deals saying, we want your trade, we're open for business, and giving more favorable trade terms to those countries or companies that are willing to negotiate with them. And that's something that could also partially offset some of the risks that you're seeing from trade with the United States. We got a question on Europe, which is, we do predict a second Brexit referendum, and we also think that the ECB might need to restart QE. What does that say about the overall stability in the Eurozone and the stability relative to the most recent crisis with Italy?
Well, Italy is a serious problem, but I think the European Union is going to stick together. I don't think there's much danger it's going to break apart. I think people are used to it now, and it creates more positive economic circumstances than negative ones. So Italy is more serious, but Italy is a legitimate manufacturer. They have the stuff to really provide some growth, but they've had irresponsible financial management both at the corporate and the government level. Nevertheless, I think the problems that Italy creates will be contained. As far as Brexit is concerned, there's another case where I think if the vote were held today, they'd vote to remain, but we'll see. We think there'll be another referendum. We're getting a lot of pushback on that surprise. We'll see whether or not that happens, but I don't see how it's going to be resolved in any other way.
Well, Byron, one last question, and this did not come from a reader. I was just inspired to ask this. Of the 10 surprises that we've talked about, and we've talked about them with a lot of clients since they came out, what are the ones where you're receiving the most pushback?
Well, getting a lot of pushback on the gold one. Almost nobody thinks, a lot of people don't think gold's going anywhere, but almost nobody thinks it's going down. Almost nobody thinks that the Fed is not going to raise rates at all, though that is changing. Most people think 1 or 2, but I think people are headed towards 0. I would say that surprisingly, not many people think the market's going to be up 15%, even though that won't even take us to the 2018 highs. So those are 3 where I'm getting a fair amount of pushback. But I would say the surprises are surprises, and that's the biggest fear I have when we start to work on them. The people will say, "Oh, these are not surprises; these are just conventional wisdom." I don't think that's the case this year.
Well, thank you, Byron, and thanks again for everyone who tuned in with us today. In closing, I would like to remind everyone that our next webinar will be April 11th. And lastly, if there were questions we didn't get to, or if there are other concerns or feedback, please let us know at Byron Wien's commentary at blackstone.com. Thank you.